Hi everyone. Today in this short video, we'll be talking about an important consideration while you are doing your revenue accounting. That is accounting in case a customer has an option for acquiring additional goods and services. We commonly call it as material right in a particular contract. Before we jump onto the topic, a brief introduction about myself. My name is Jatin Agarwal. I'm a chartered accountant by qualification. Now having a post-qualification experience of more than 11 years, all in accounting and financial reporting and auditing matters. So the idea over here is to give you a quick overview of what are the basic principles of Ind AS 115 or IFRS 15, and then we'll talk about how do you really account for a material right? What is this material right, which is material right related guidance, which is given in IFRS 15. So IFRS 15, as you all know, is a standard which talks about revenue from contract with customers. This is a standard which gives you a guidance in terms of how do you recognize revenue when you have contract with the customers. So basic premise of this standard is that you would have a contract with the customer. Within this contract, you would have different promises being made to the customer, and based on how and when those performances are when those promises are getting fulfilled, you will recognize your revenue. So for that, you will have a total consideration in the contract. That total consideration in the contract will be divided in the different promises first, and as and when those promises are getting satisfied, then you will keep on recording your revenue relating to those promises only. Right. So basic this entire framework of IFRS 15 in designed in a 5-step model. What is this 5-step model? First step is identifying the contract with the customers. Second is identifying the promises, which is called as identifying the various performance obligations in the contract. Then is determining what is the transaction price, that is determining what is the consideration in the contract, and then allocating that transaction price in the different promises that we have identified in step number 2. And there is a guidance in terms of how do you allocate those transaction price. And finally, there is a guidance in terms of revenue recognition. Last step is the step when you actually recognize your revenue, and this step gives you a guidance as to when and how do you assess that your promises are getting satisfied. Whether it is getting satisfied over the period of time, at a period of time, at a point in time, is all. This is the guidance which is given in this particular step. In this short 10 minutes video, I will be taking you through the guidance in IFRS 15 related to material rights. So what is this material right? What am I actually talking about? You would have seen that there are certain contracts with the customer which actually gives them an option to buy additional goods and services in future at a discounted price. What could be the examples of these kind of a contract? For example, an entity is selling a gym membership for rupees 10,000 in the first year, and those members have an option to renew their membership in the second year at a discounted price of 7,000 in next year. Right. So basically, first transaction is at 10,000 and the second transaction is at a discounted price of 7,000. Similarly, let's say we have an example where an entity has a scheme wherein it says that if you buy a product for rupees 1,000 today, you will be entitled to an additional 40% discount, an additional discount of 40% in your subsequent purchases. The concept behind this guidance on material right is that if the option that is given to the customer to acquire additional goods and services in future falls under the purview of material right, then that material right is actually treated as a separate performance obligation in the first transaction. In other words, what will happen is that the total consideration that an entity is receiving for its first transaction will then get divided into two portions. And the portion which is attributed to this material right, the revenue for that particular portion will be deferred and will actually be recorded in the company's P&L when that material right is utilized by that particular customer. We'll talk about this in my subsequent slides with the help of an example. Firstly, let's concentrate on the concept. The concept is, as we discussed, that if that option to acquire additional goods and services is a material right, that would be resulting into a separate performance obligation, and the revenue related to this separate performance obligation will not be recognized along with the revenue for the first transaction. It will be deferred and it will be recorded when this actual right, this option to acquire additional goods and services, is actually utilized by that particular customer. If this is not a material right, then there is no question of a separate performance obligation, and the entire revenue of day one transaction or the initial transaction will be recorded on day one only. So what is this material right? The question that we need to answer is whether first transaction entitles the customer to get incremental discount in second transaction. A very important point that we need to answer is that if a customer has an option to acquire an additional goods and services at a price that would reflect the standalone selling price for that goods and services. If a customer would be entitled to acquire additional goods and services at a price that would reflect the standalone selling price of those goods and services at that point in time, then there is no material right which is given in the question. There is no material right involved in this. There is no incremental discount which is given to the customer. And hence it is not a separate performance obligation. Let's try and understand this accounting for material right with the help of an example. Let's say we have a company A Limited and this owns 20 resorts in India. And every time a customer visits any of the resorts and spends rupees 100, he is entitled to 1 point. And this 1 point is equivalent to rupees 5, which he can encash in any of the subsequent transactions. And company's historical trend says that these points are 100% encashed by its customers, right? So let's say we have a customer X in this situation and he spends 10,000 rupees and he earns 100 points. That means he is entitled to 500 rupees of additional discount, which he can encash in his second visit. In this example, entity A is getting a total consideration of 10,000 rupees, but it has made two promises in this contract. First promise is to provide hotel accommodation in the first transaction during the first stay period. And also it has made a promise of additional discount in its subsequent stays, right? So what standard requires us to do is to allocate this total consideration of 10,000 in the two performance obligation. And this allocation will be done basis the standalone prices of the two promises which are made in the contract. In this transaction, we have allocated rupees 476 to this material right. So my day one accounting entry would be cash account debit 10,000. I will recognize a revenue of 9,524 and balance 476. I will park in an account which is called as a deferred revenue at the time of second transaction, which is deferred revenue account debit to revenue, which is 476. I hope now this clarifies you on the concept of material right. Thank you so much and have a nice day.